Okay, so the world of investing. It can seem kind of like, I don't know, a jungle, right?
Mhm.
But what if I told you there are, like, simpler paths? Paths that could help you grow your money. Today, we're diving into 3 ways you can start investing. You don't need to be an expert. You can be a total beginner.
Yeah, we all start somewhere.
Exactly. And to help us out, we're turning to, I guess you could call him a YouTube investing guru, Wall Street Trapper. He's got this video, 3 ways to start investing for beginners. He's like super engaging. Makes it all seem less scary.
He really does. I like how he makes it feel like anyone can invest, you know? It's not just for, like, Wall Street guys.
Totally. Okay, so his first strategy is all about ETFs. Those are exchange-traded funds, in case you didn't know.
Oh.
He uses this really clever analogy. He compares them to a snack aisle at the grocery store.
I like that.
Right. So imagine, like, instead of just buying one bag of chips, you get a whole variety pack. That's what ETFs are like. They're a bunch of different companies all bundled together.
So instead of putting all your money into one company, you're spreading it out.
Diversification, right?
Bingo. It's like the whole don't put all your eggs in one basket thing. And he uses this example, the XLK ETF. It's focused on all those big tech companies like Apple, Microsoft, NVIDIA. So like if you invested $1,000 in XLK, a chunk of that would go to each of those companies. It's like owning a tiny piece of all those giants.
It is. And one thing to watch out for, though, is the expense ratio. That's like a fee the fund managers charge. You want to make sure it's low, like ideally under 0.5%. That way, more of your money is actually working for you.
Right, right. Keep those fees low. So diversification, targeted sectors, and watching that expense ratio.
Got it. Okay, the next strategy is all about real estate, but like not the way you usually think about it. We're talking REITs. He uses the example of, walking through a mall. It really made it click for me.
It's a good visual. Think about companies like Simon Property Group. They own those big malls like Fix Plaza, Lenox Square. They're a REIT, or real estate investment trust. REITs own all these properties like malls, outlet stores, even those storage places like public storage. And here's the cool part. They have to pay out a big portion of their profits to shareholders as dividends.
Dividends, like you're actually making money just from owning the REIT.
Exactly. It's passive income.
That's pretty sweet.
Yeah.
Though Wall Street Trapper does say that REIT stock prices, they tend to move sideways, which means they grow slower than some other investments.
That's true. They might not be the best for like super fast growth, but they can be really reliable for income. It all depends on what your goals are.
Right. What are you looking for?
Yeah.
And here's a fun fact. Get this. Iron Mountain, the company that stores all those boxes of old records, they're a REIT too. Who would have thought?
It just goes to show there's so much variety within REITs. It's not just about those fancy malls, right?
No kidding.
Okay.
So we've got ETFs for diversification and REITs for some sweet passive income. And his last strategy is all about the S&P 500. That index that tracks the 500 biggest companies in the U.S. Well, he actually calls it his, get this, savings account. I was like, what?
That got my attention too.
Right. I mean, why would he call it that?
Well, think about it. The S&P 500 is like the all-star team of the stock market, right?
Yep.
By investing in it, you're basically betting on the entire U.S. economy. It's very diversified because it covers all those companies, so it's less risky than picking individual stocks.
And historically, it has done pretty well.
Yeah, and he points out that the market has been up 76% of the time. Statistically, it's in your favor if you're investing for the long term.
76%. Wow, so it's like a pretty safe bet then.
Well, no investment is totally safe, but the odds are definitely in your favor with the S&P 500, especially over the long haul. And there are these things called index funds like SPY and VOO. They let you invest in the S&P 500 really easily. It's like buying a ticket to the whole game instead of just betting on one player.
So you're not stressing about picking the right companies. You're just trusting in the overall strength of the entire market.
Makes sense. Okay, so before we move on, I got to ask about this. Wall Street Trapper mentions this cheat code. He says, to find strong companies, we should look at the top holdings of those successful ETFs. Is that like a real thing, a strategy people actually use?
Yeah, it can be. Those top holdings are usually the market leaders. They have great products, brand recognition, and what we call moats.
Moots, like the ones around castles.
Exactly. It means they have a competitive advantage, something that makes it tough for other companies to steal their customers. Think of Apple, right? They've got millions of loyal users. Or NVIDIA, they're dominating the chip market.
So those top holdings are like companies with like fortresses around them. Harder to take down, more likely to succeed in the long run.
Exactly. They usually have a good track record, and they're better at handling those, ups and downs in the market.
Okay, so we've got three paths here: ETFs, REITs, and the S&P 500. Are we feeling a little less lost in the investing jungle now? I hope so. Each one offers a different way to grow your money, and they all have their own risks and rewards.
And the coolest part is, this is just the beginning. There's so much more to learn about each of these strategies.
Right, it's a journey. And like any journey, the best part is figuring out what works for you, what are your goals, how much risk are you comfortable with. It's all about finding your own path.
I love that. Okay, so stay tuned because we're going to keep digging into all this in just a bit.
So are you ready to dig a little deeper into these strategies?
I am. Let's say, I'm really into those ETFs. How do I even choose the right ones? There are just so many out there.
So many, right? It can be overwhelming. But Wall Street Trapper gives us another good tip. He says to look at the top holdings of ETFs on websites like etfdb.com.
So we can kind of see what those fund managers are doing, see which companies they're choosing.
Yeah. It's like, getting a peek behind the scenes. And it can help you narrow down your research, find companies that, fit what you're looking for.
Okay, I like that. Like a shortcut. But let's back up for a sec. Why should someone even bother with all this investing stuff? What's the point?
That's the big question, right? Why do we invest? Well, it's about taking charge of your money, growing it over time, hopefully, beating inflation and building some wealth.
Like planting seeds that'll grow into a big, beautiful garden someday.
I love that analogy. And these strategies, the ETFs, REITs, the S&P 500, they're like different types of seeds, different growth potential, different levels of risk.
Makes sense. So what if someone's really interested in those REITs, the ones that can give you passive income? What should they know?
Well, first, it's important to know there are different types of REITs. We talked about the ones that own malls, the retail REITs, but there are also residential REITs, healthcare REITs, industrial REITs.
Wait, hold on. So there are REITs that own, apartments
Yeah,
and hospitals.
yeah. Residential REITs own apartment buildings. Healthcare REITs invest in hospitals and senior living facilities. Industrial REITs own warehouses, distribution centers, things like that.
Wow, I had no idea. So wouldn't those different types perform differently depending on what's happening in the world? Wouldn't online shopping affect those mall REITs?
You're totally right. It all depends on what's happening in those industries. Online shopping has been tough on some retail REITs, but it's actually been good for the industrial REITs because they handle all those deliveries. It shows how important it is to keep up with those bigger trends.
So understand the different types of REITs and keep an eye on those big picture trends. What else?
The management team matters a lot, just like with any company. Look for REITs with, experienced leaders, people who have a good track record.
So we're not just looking at buildings, we're looking at the people running them. Got it. Anything else that can help us figure out if a REIT is a good investment?
Oh, yeah. Dive into their financials. I know it can seem scary, but it's worth it. Look at things like the occupancy rate. That's the percentage of rented space. Higher is better. And the debt to equity ratio. Lower is better because it means they're not using as much debt to run their business. It makes them, stronger during those tough economic times.
Well, it's like checking their financial health before you commit, right? I'm starting to see how knowing this stuff can make me a better investor. Okay, but what about diversification within REITs? Should we put all our money into just one REIT?
Definitely not. Diversify, diversify, diversify. It's just as important with REITs as it is with stocks, and REIT ETFs are a great way to do that. They hold a bunch of different REITs, so you're automatically diversified.
So I could have an ETF that's just healthcare REITs, or one that mixes a bunch of different types.
Exactly. And don't forget about diversifying geographically, too. Investing in REITs across different areas, or even different countries, can help spread out that risk.
Okay, diversification check. Earlier, we talked about how REIT stock prices tend to move sideways, meaning they grow slowly. Why is that?
Well, remember how REITs have to pay those big dividends? That means they have less money left over to reinvest and grow super fast. Plus, they're often seen as, more stable investments because they're backed by real estate.
So it's that trade-off again, huh? Stability and income versus potentially faster growth.
Yep. And again, the best choice depends on what you want to achieve with your investments, your goals, your risk tolerance, all that.
Okay, let's switch gears now and talk about the S&P 500. Wall Street Trapper calls it his savings account. I love that. It's like the all-star team of the U.S. stock market. Why is that such a good strategy?
Because with the S&P 500, you're essentially investing in the entire U.S. economy, right?
Yeah.
And it's immediately diversified because it covers all those different companies, way less risky than picking individual stocks.
We talk about how historically it's had really positive returns, but how do we actually invest in it?
Mm-hmm.
It's those index funds again, right?
You got it. Index funds like SPY and VOO are made to mirror the performance of the S&P 500. They're passively managed, so they just track the index, which keeps the fees low. It's a super easy, efficient way to get in on that all-star team action.
So no need to stress about picking individual stocks. Just invest in the whole team. What are some of the big pluses of this approach?
Well, besides the diversification and the good track record, the S&P 500 is always changing, right? As companies grow or shrink, the index adjusts what it holds.
So you're always invested in the top performers, even as things shift around. Pretty cool. But are there any, downsides we should know about?
Of course. Past performance is a good sign, but it doesn't guarantee anything for the future, right? Markets change and there are always risks.
True, true. No investment is foolproof.
Another thing to think about is that the S&P 500 is heavily weighted towards large cap stocks, those giant companies worth billions. So it doesn't really represent those smaller companies that might have more potential to grow quickly.
Oh, so it's another one of those trade-offs,
Yeah.
the stability of the big companies versus the potential for faster growth with smaller ones.
Exactly. And again, the right choice for you depends on your goals and how much risk you're okay with.
Okay, so we've talked about ETFs, REITs, the S&P 500. That's a lot. What's the main thing you want our listeners to take away from all this?
I want them to know that investing isn't this big mystery. There are strategies for everyone, whether you're just starting out or you've been investing for a while. It's about finding what works for you, doing your research, and building a portfolio that, helps you reach your goals.
It's about taking control, right?
Yeah.
Not just about making money, but about making smart decisions that can help you in the long run.
Yes. Investing is a journey, not a race. It takes patience, discipline, and a willingness to keep learning.
Love that. Okay, before we move on, I want to go back to that idea of looking at the top holdings of ETFs. What if we took that a step further, really zoomed in?
Okay, I'm listening. What do you have in mind?
So what if we don't just look at those top holdings? What if we dive into the whole list of what's inside an ETF? Really see all the companies it holds. It'd be like seeing what the fund manager's really interested in, their whole strategy.
Oh, I see what you're saying. It's like getting a behind-the-scenes look at their playbook. Yeah, that's a great idea. By looking at all those companies, you can figure out what the fund manager is thinking, right? Are they focused on a certain sector? Maybe they're big on renewable energy or AI. Or maybe they're all about companies with strong, ESG practices?
Yeah, ESG, environmental, social, and governance. So it's like we're detectives, right? Looking for clues to figure out the big trends driving the market.
Exactly. And that kind of deep dive can give you new ideas for investing, things you might not have thought of before. It's all about, connecting the dots.
Wall Street Trapper really gave us a lot to think about, huh? It's crazy how one YouTube video can, open up so many possibilities.
It really shows you how powerful it can be to, break down those complicated ideas. Investing doesn't have to be scary.
No, not at all. We've learned about ETFs, REITs, the S&P 500, so many different ways to, grow your money. And it's pretty awesome to realize that we actually have options. We can take charge of our own finances.
That's the key. It's not about, getting rich overnight or anything. It's about being smart with your money, making choices that will help you reach your goals.
So for anyone listening, what's one thing they can do, today, start using these strategies?
Honestly, just start. Even if it's opening a brokerage account with a small amount of money, buy one share of an ETF or even a fractional share. Taking that first step is the biggest hurdle.
It's like they say, a journey of 1,000 miles.
Begins with a single step.
Exactly.
And there's so much help out there. You can research different brokerages, check out educational websites, even talk to a financial advisor.
Just be curious, ask questions, and never stop learning. Investing is a journey, not a destination.
Right. Couldn't have said it better myself. And you don't have to do it alone either. There are online communities, books, podcasts, tons of ways to connect with other people and learn from their experiences.
I love that. Well, as we wrap up this deep dive into investing for beginners, I want to leave our listeners with one last thought. We've talked about diversification, different types of investments, finding things that match your goals. But at the end of the day, investing can also be about, believing in something bigger.
What do you mean?
You can invest in a company that's working on, I don't know, life-saving medicine, or a business that's making a positive impact on the world. Our investments can reflect our values.
I like that. It's like our money can help create the kind of future we want to see.
Exactly. So, to everyone listening, we hope this deep dive has inspired you to start your own investing journey. Remember, it all starts now.
And have fun with it. Make smart decisions, keep learning, and enjoy watching your knowledge and hopefully your portfolio grow.